Welcome to the Trade Savvy Academy, to a gripping tale of courage, strategy, and astonishing success. This is the story of Charlie, an ordinary guy who turned a humble $10,000 into a jaw-dropping $1 million through smart investing, disciplined trading, and the power of dividends. His journey begins in the chaotic late 1990s, during the dot-com bubble's feverish peak. How did Charlie weather the 2008 financial crisis? What unexpected twist propelled his portfolio to seven figures? And what's the one secret move that defined his triumph? Stick around until the end to uncover a transformative strategy that could reshape your investing journey. Let's dive into Charlie's epic saga. It was 1999, and the world was electrified by the dot-com boom. The internet was the new frontier, and stocks with .com in their names were rocketing skyward. Charlie, a 25-year-old college grad grinding at a 9-to-5, had saved $10,000. He wasn't a finance whiz, just a curious soul who'd read The Intelligent Investor by Benjamin Graham and felt a spark of ambition. The dot-com bubble was intoxicating, with companies like Pets.com and Webvan hailed as revolutionary. Charlie could have chased the hype, but he trusted his gut. Diversification was the way to go. He split his $10,000 into 5 investments, putting $2,000 into each to balance risk and opportunity. Let's explore his choices. Charlie invested $2,000 in Microsoft, the tech giant ruling with Windows. At $50 per share, pre-split, he bought 40 shares. Next, he chose Cisco Systems, CSCO, the backbone of internet infrastructure, at $30 per share, grabbing 66 shares. For stability, he picked Johnson & Johnson, a healthcare titan, at $40 per share, securing 50 shares. He also selected Procter & Gamble, PG, the consumer goods giant behind Tide and Pampers, at $35 per share, netting 57 shares. Finally, Charlie bet on Amazon, AMZN, a scrappy online bookstore trading at $80 per share. He bought 25 shares, captivated by Jeff Bezos's bold vision. His portfolio blended tech innovators with reliable dividend payers, setting the stage for a wild ride. Unbeknownst to Charlie, the dot-com crash was looming. By early 2000, the dot-com bubble burst. Pets.com collapsed, and tech stocks cratered. Charlie's portfolio took a hit. Microsoft dropped to $30, reducing his 40 shares to $1,200. Cisco fell to $15, slashing his 66 shares to $990. Amazon was crushed, plummeting to $7 per share, leaving his 25 shares worth just $175. His tech bets were reeling, but Charlie's diversification saved him. Johnson & Johnson and Procter & Gamble held steady, with J&J at $38 and PG climbing to $40. Their dividends, small at 2 to 3% yields, delivered $50 to $100 a year, which Charlie reinvested. He could have panicked and sold, but he remembered Warren Buffett's advice: be fearful when others are greedy, and greedy when others are fearful. Charlie stayed put. Those dividends were Charlie's anchor. He used them to buy more Microsoft and Cisco shares at their lows. By 2002, he'd added a few extra shares of each. His portfolio was bruised, valued at $8,500 by 2003, a 15% loss from his $10,000. Amazon began to recover, hitting $20, sparking hope. Charlie learned a vital lesson: markets crash, but quality companies rebound. His portfolio was poised for growth, but the 2000s would bring bigger tests and a game-changing opportunity. The mid-2000s were a golden era. The economy roared, and Charlie's portfolio flourished. Microsoft climbed to $40, Cisco hit $25, and Amazon soared to $80 by 2007. Johnson & Johnson and Procter & Gamble reached $60 and $65, with dividends growing to 3 to 4%, yielding $300 a year. Charlie reinvested every cent, compounding his gains. By 2007, his portfolio was worth $22,000, more than double his initial investment. He felt unstoppable. But then, 2008 struck with the financial crisis. Banks failed, markets plunged 50%, and fear gripped the globe. Charlie's portfolio wasn't spared. Microsoft fell to $20, Cisco to $15, and Amazon dropped to $40. Even Johnson & Johnson and Procter & Gamble dipped to $50 and $55. His $22,000 portfolio shrank to $14,000 by early 2009. It was a dark moment. Charlie stared at his brokerage account, questioning his path. But his diversification and dividends held firm. J&J and PG kept paying, and their yields rose as prices fell, delivering $400 a year. Charlie used that cash to buy more Amazon at $40. In 2009, he also added Apple APL as the iPhone reshaped tech at $15 per share, pre-split. He invested $2,000 from savings, buying 133 shares. This move, along with a later bet, would redefine his journey. In 2010, as the market recovered, Charlie made a fateful decision. A friend mentioned Tesla Motors, TSLA, a quirky electric car company that had just gone public. Charlie had no idea Tesla would become a juggernaut. He thought it was a long-shot bet on a cool idea. With $2,000 from savings, he bought 117 Tesla shares at $17 per share, post-IPO. He saw Elon Musk as a dreamer, but never imagined this stock would transform his portfolio. Meanwhile, his other holdings thrived.
Microsoft, reborn as a cloud leader, hit $100 by 2018. Cisco stabilized at $50. Amazon exploded to $1,800. Johnson & Johnson and Procter & Gamble reached $130 and $100.
With dividends yielding $600 a year. Apple soared to $50, pre-split, making Charlie's 133 shares worth $6,650. Tesla began to climb, hitting $350 by 2018, valuing his 117 shares at $40,950. By 2018, Charlie's portfolio was humming. His 40 Microsoft shares, plus extras, were worth $4,000. His 70 Cisco shares were worth $3,500. His 55 J&J shares were worth $7,150. His 60 PG shares were worth $6,000. His 25 Amazon shares were worth $45,000. His 133 Apple shares were worth $6,650. His 117 Tesla shares were worth $40,950. Total value, $113,250, excluding later investments cost basis. From $10,000 to over $110,000 in under 20 years, despite 2 crashes. Charlie's diversification, dividend reinvestment, and Tesla's unexpected surge were working magic. But Tesla's volatility was about to spark a pivotal shift. The 2000s were a roller coaster. The pandemic crashed markets in 2020, but Charlie saw opportunity. He added $5,000 to buy 10 more Tesla shares at $500 post-split and $3,000 for 20 NVIDIA shares at $150 as AI gained traction. Tesla became a phenomenon, soaring to $4,000 by 2022, post-split adjusted, amid EV mania. Charlie's 127 Tesla shares, 117 plus 10, were worth $508,000, a staggering return from his $7,000 investment. His other stocks shone too. Microsoft hit $450 by 2025, Cisco $80, Amazon $4,000, Apple $250, J&J $200, and PG $180. NVIDIA climbed to $3,500, making his 20 shares worth $70,000. By 2022, Charlie's portfolio was nearing $700,000, with Tesla driving the bulk. But Tesla's wild swings, doubling one month, dropping 20% the next, kept Charlie awake. He'd hit the jackpot, but its volatility felt like a ticking time bomb. In 2022, near Tesla's peak at $4,000, Charlie made a bold move. He sold all 127 Tesla shares, pocketing $508,000. He didn't foresee Tesla's future dips or climbs. He just wanted stability. Seeking conservative, dividend-focused investments, Charlie funneled the proceeds into 2 ETFs, Schwab U.S. Dividend Equity ETF, SCHD, at $80 per share, buying 3,500 shares, and Vanguard Dividend Appreciation ETF, VIG, at $160 per share, buying 1,500 shares. SCHD and VIG, with 3 to 4% yields and exposure to stable giants like Home Depot and Visa, offered steady income and growth. Charlie's Tesla windfall was now a dividend machine, generating $12,000 annually. By May 2025, Charlie's portfolio reflected his strategic shift. Microsoft trades at $450, making his 45 shares worth $20,250. Cisco is at $80, so his 75 shares are worth $6,000. Johnson & Johnson is at $200, so his 60 shares are worth $12,000. Procter & Gamble is at $180, making his 65 shares worth $11,700. Amazon is at $4,000, so his 27 shares are worth $108,000. Apple is at $250, so his 140 shares are worth $35,000. Nvidia is at $3,500, making his 20 shares worth $70,000. SCHD is at $100, so his 3,500 shares are worth $350,000. VG is at $200. 1,500 shares are worth $300,000. Total portfolio value, $1,012,950. Annual dividends from SCHD, VIG, J&J, PG, and Apple are $15,000, which Charlie reinvests. From $10,000 to over $1 million in 26 years, an annualized return of 18%, trouncing the S&P 500's 8%. Charlie's success came from diversification, reinvesting dividends, and a lucky Tesla bet he never expected to explode. Selling Tesla near its 2022 peak and pivoting to SCHD and VIG, locked in gains and ensured steady income, taming the volatility that defined his Tesla ride. His portfolio weathered the dot-com crash, 2008 crisis, and pandemic, proving resilience and adaptability. What was the secret move teased at the start? It's not a stock pick or a trading hack. It's adaptability. Charlie's genius was knowing when to hold, when to buy, and when to pivot. He diversified across tech, healthcare, and consumer goods, reinvested dividends, and took a chance on Tesla without expecting its meteoric rise. When Tesla's volatility became too much, he sold near its peak and shifted to stable ETFs like SCHD and VIG. Every crash was a buying opportunity. Every dividend was a chance to compound. Charlie's adaptability, pairing bold bets with conservative moves, turned $10,000 into $1 million. It's a blueprint anyone can follow with discipline and flexibility. Charlie's story is a masterclass in wealth building. He started with $10,000 and no insider edge, just a hunger to learn. Diversification shielded him from the dot-com crash and 2008 meltdown. Dividends from J&J and PG fueled reinvestment, compounding his wealth. His Tesla bet, a speculative punt, delivered life-changing returns, but he didn't let greed cloud his judgment. Selling Tesla and moving to SCHD and VIG showed his ability to adapt, balancing growth with stability. Charlie's million-dollar portfolio proves that wealth isn't about perfect timing. It's about consistent action, calculated risks, and staying calm through chaos. His journey inspires us all to start small, stay steady, and think long-term. Charlie's journey shows what's possible. Start investing now, even with $100. Diversify across sectors, tech, healthcare, ETFs. Choose companies and funds with strong fundamentals and dividends. Reinvest those dividends to compound your wealth. Take calculated risks, but know when to pivot to stability. Above all, be adaptable. The market will challenge you, but the rewards are life-changing. Want more investing wisdom? Drop a comment, hit that like button, and subscribe for more stories like Charlie's. His million-dollar saga is just the beginning. Let's build wealth together.